Welcome to The Explainer. Today, we're going to tear apart the market's sudden panic over AI. We'll break down everything that went down on February 17th so you get a clear, actionable story of what really happened. Okay, let's just dive right in. The market came back from the holiday, and it had a serious case of anxiety. It all boiled down to one huge question. So we're talking about the AI hangover. Right out of the gate, the morning kicked off with this really sharp sell-off. And it was all driven by this growing fear that the very same AI that's been fueling this bull market might now be its biggest threat. And you can see it here, just a sea of red right at the open. The selling was immediate, it was widespread, and tech took the biggest punch. This was a classic sell first, ask questions later kind of vibe, just pure risk off. And look, this wasn't just some minor dip. The VIX, the market's fear gauge, it spiked. And I mean it spiked hard. That tells you this was genuine panic. We're talking about traders literally scrambling to buy protection, insurance against more losses. And this is where it gets really interesting, because the fear started to spread. This slide illustrates the core problem perfectly. It's not just a tech story anymore. The anxiety, the contagion, it's hitting wealth management, logistics, financial services, pretty much anything with white-collar tasks. And that software ETF, IGV, getting hammered by over 2%, yeah, that tells you the whole story right there.
Okay, but here's the twist. The sell-off wasn't happening everywhere. Beneath the surface, something else was going on. A massive rotation that was basically splitting the market right in two. Let's dig into what that looked like.
So you had this great divide. On one side, you've got what we're calling the replicable, software and middlemen companies. They got absolutely crushed. I mean, the software ETF, IGV, plunged because investors are spooked that AI can just replicate their code. But then on the other side, you have the resilient, the builders, the hardware makers. Mega caps like Apple and NVIDIA actually rebounded. Why? Because their physical stuff, their infrastructure, is essential. You can't just code that into existence.
And this quote, this just nails it. It's from an article called Hunt for Losers, and it perfectly captures the huge shift we're seeing. For 15 years, the mantra was software is eating the world, right? And we punished anyone who actually, dealt with physical stuff, atoms, factories, warehouses. That playbook is being torn up as we speak.
So what's the big takeaway here? It's this. The old fight, the whole growth versus value debate, it's kind of over. The new battle, the one that completely defined today's trading, is resilience versus replicability. It all comes down to one question. Can your business be copied by an AI script, or do you own the actual uncopyable atoms? All right, so if that's the new reality, how do you navigate it? Well, to figure that out, we're looking at a brand new framework, a new rule book that analysts, especially those over at PhilStockWorld and the AGI Roundtable, are starting to use to figure out where the real value is.
And they're calling it the matrix economy. I love that. The strategy is actually pretty simple. You invest in the companies that are building the matrix, the physical infrastructure, the energy, the hardware. You don't invest in the easily replicable software that's just running around inside of it.
And check this out. This is a look at PhilStockWorld's Money Talk portfolio, and it shows this theory in action. You see it's heavy on the builders, think applied materials, and physical assets like trucking companies. But notice what gets a yellow flag? The financial models, the Invescos, and Synchronies of the world, the ones that are most vulnerable to getting squeezed by AI competition.
So that's the theory. But how do you actually apply this stuff in real time when the market's going crazy? Well, let's look at 3 specific plays that the folks at the AGI Roundtable flagged during their live session today.
First up, we have an insight from Anya, their AGI psychologist. And she spotted this huge gap between what everyday retail investors are seeing and what the elite, the smart money, are actually doing. And this is a tale of two realities. On one side, you have the retail hallucination, right? A viral craze for a program called OpenClaw caused a rally in Raspberry Pi, the maker of $50 hobbyist computers. This is pure sentiment, totally detached from revenue. Meanwhile, in elite reality, smart money is focused on tangible, premium assets. They see that top-tier commercial real estate isn't just in recovery anymore, it's in full-blown expansion.
Okay, next up, Sherlock, the AGI analyst, sniffed out a classic opportunity. This is a case where the market was just punishing a really solid company, simply because things got a little complicated. So here's what happened. Genuine Parts, or GPC, this is a dividend king, mind you, it drops 13%. Why? because they missed on earnings and announced they're splitting into two companies. Now, the market hates that kind of complexity and just sells it off hard. But Sherlock's insight is that this is not a crisis. History shows that when these big companies split, the sum of the parts is often worth way more than the whole. So the play? You buy the panic. You get a legacy industrial distributor at a massive discount right before it potentially unlocks a ton of new value.
And for our last play, let's turn to Warren 2.0, the AGI value investor, who found what's called a cigar butt trade. It's a classic deep value concept, a beaten-down stock that the market has tossed aside, but it's still got one good puff of profit left in it.
And that trade was Bayer. Now, the problem with Bayer for years has been the billions in litigation costs from that Monsanto/Roundup deal. It just crushed the stock. But here's the catalyst. News just broke that Bayer is preparing a $10.5 billion settlement to resolve all these cancer lawsuits. So the trade is simple. You buy the stock just as that massive dark cloud of litigation risk is finally being removed. You're turning what was a market pariah into a box of Habanas.
So after all that, the crazy morning panic, the market splitting in two, all these strategic trades, how did the day's final score actually look?
You're not going to believe this. It was almost perfectly flat. The S&P, the NASDAQ, the Dow, all up just 0.1%. Looking at this, you'd think it was the most boring day ever. You'd think nothing happened at all.
But we know better, don't we? As we've just seen, that incredibly calm surface was hiding a violent rotation underneath. Money didn't just pack up and leave the market today. Oh no, it just moved. It fled from the replicable world of software and poured into the resilient world of physical assets.
And so that leaves us with the single most important question for any investor trying to make sense of today's market. Is your portfolio built for the old world, or is it built for the matrix? Thanks for doing this explainer.